Hello, everybody. Welcome to another episode of Canadian Mortgage Weekly. It's your host, Joe Bladdock, here today. And I'm really excited because it's been a while since I've started the lives again. And this year, I want to get them going because there's a lot of news coming out right now in mortgages, specifically a lot of talk about tariffs. So we're going to cover that today. And we're also going to cover some of the other mortgage news that will affect mortgage rates. And it's a really interesting market right now because we have come off a big rate increase cycle where the Bank of Canada did increase rates quite considerably over the last few years. And just recently, they announced that they're done with quantitative tightening. And that was actually at the last Bank of Canada meeting there. That was in January on the 29th. Where it actually lowered the interest rate by a quarter point. So, in fact, their rates have gone down a quarter point, and we are seeing the end of quantitative tightening could mean great news for homeowners in Canada. And with that, though, we also have tariffs, and tariffs have been creeping in with the recent U.S. election. And with all the tariffs out there, a lot of my clients are asking me, Joe, should I lock in early? Joe, should I look at getting a mortgage renewal early? So I want to cover that today because there's just a lot of unknowns there with that. So when I'm looking at what's out there, let's take a look at what rates are doing today. And let's take a look at how the news of tariffs have been affecting fixed rates and mortgage rates that way. So if I look at the typical things that I look at here, for example, the 5-year Canadian bond yield, that actually predicts what the 5-year fixed interest rate is going to be. And it's hovering around 2.66% as of this morning. Now, since the U.S. election, it has gone down quite considerably from 3.2%. So that's a decrease of a half a percentage point. Now, I really haven't seen fixed rates move too much from the lender's side. And that just could mean that they are waiting until the first big lender makes the big move to start adjusting rates. And usually that first lender is one of the big banks, typically one of the big banks, and they start a promotion and then everyone else follows suit. But right now, I'm anticipating that fixed rates could drop at any day now based on whatever a large bank will do. And it's going to be interesting to see that because a lot of my clients have been asking, Joe, we want our rate to be lower. We see the Bank of Canada lowering rates. How come we don't have a lower rate? Well, fixed rates kind of lag in the market. Variable rates go first. So if variable rates go down, fixed rates will lag and stay higher for a little while, and then they will start to fall. Similarly, the same thing started to happen when variable rates started to go up. Variable rates went up so fast, fixed rates were lagging behind, increasing at a slower pace. So I'm watching right now to see if any big banks come out with any promotions. Oh, look at that. The 5-year bank bond yield just dropped to 2.65% from 2.66. So it continues to drop this morning. Let's take a look at some other metrics this morning. I want to take a look at the Canadian inflation rate. That also is going to tell us a little bit about where rates are going. All right, so taking a look at the inflation rate, I do see it's been on its way down. We had this time last year, it was around 2.9%. And then this year, it's at around 1.8%. We have January's numbers coming in on February 18th. So that will happen in about 12 days. So excited to see that. Right now with inflation at 1.8%, We almost need rate cuts to stimulate the economy, but if the rate cuts aren't stimulating the economy enough, inflation will continue to go down. So that's an interesting metric there. Let's take a look at another one here. Let's take a look at the United States inflation rate. Now, on the other side, the United States inflation rate has been increasing since September of 2024. It was at 2.4% in September and then increased to 2.9% in December. We could see possibly the inflation rate continue to go up for the United States in January. We are to get those numbers on February 12th, so that's in 6 more days. So that's going to be an interesting number when it comes out. Okay, and let's take a look now at the housing starts. Well, the housing market actually. All right, so the average sold price in Canada right now is $676,640. So with that, it's actually a 1 month change of minus 2.6%, but it is up 3% over the 12-month period. So it depends on which way you look at it. However, if I'm looking at a graph of the average national house price, I do see that it peaked around October of last year in the fall, and also in April in the spring. But right now we are on the way down, and that's typical for the winter. However, overall, we are on an upward trajectory. If we look at the graph here, we are seeing the line increase overall. Another metric I like to look at is the monthly jobs report for Canada. And that monthly jobs report today is showing that unemployment is at 6.5%. That's an increase of 0.8 from the previous year. So another good indication that rates should go down. All right. So what does all this mean? We're seeing all these indicators, unemployment, inflation for Canada should go down. US, inflation will go up. I don't think the US will have lower rates anytime soon. That could impact the Canadian economy quite considerably in the way that we don't decrease rates as fast as we would. But on our end, we are seeing the banks forecast rate cuts because of the tariffs. As of this morning, we are seeing that the Bank of Montreal is coming out with a article saying that tariffs will actually decrease rates quite considerably, and that the Bank of Canada rate will drop to 1.5%. And that doesn't mean that the customer rate will be 1.5%. That would mean that the Bank of Canada rate is 1.5%. Right now, the Bank of Canada rate is at 3%. So that would indicate that that will drop 150 basis points still between now and when that happens. So BMO is projecting 1.5% by year end. That's a big change because before that it was 2.5% by year end. Also, we are seeing a lot of other banks forecast rates around the 2% to 2.25% for the Bank of Canada rate, which also indicates cuts of 50 basis points or 75 basis points. So overall, we are seeing that cuts will happen. A lot of banks are indicating that. And with tariffs, we are seeing that it could justify an emergency Bank of Canada cut action. So if that is the case, what mortgages are you taking these days? Are you taking a variable rate mortgage? Are you taking a fixed rate mortgage? Are you taking a short-term fixed rate mortgage? All these are factors that I would recommend you consider before signing a mortgage today, because with tariffs coming around the corner, we could see rates drop quite considerably. That's always a could, but if they do, you want to be able to take advantage of that if you can. So planning ahead always helps. And you can always contact me. I'm a mortgage broker in Ontario, and we can talk about how tariffs can affect your mortgage. But if you're just tuning in now, tariffs are expected to bring the Canadian mortgage rates down. BMO's predicting another 1.5%. So that is really great news for all Canadians out there. Anyway, thanks for watching. This has been Canadian Mortgage Weekly for the week of February 6th, episode 184. Make sure you follow my channel and stay tuned for more updates. And we'll talk to you all later. If you need any mortgage advice, make sure you contact me in the link description below. You can set an appointment. I'd be happy to review your mortgage with you.